Imagine your country's money. You probably think of physical cash, the notes and coins in your wallet. You might also think of the numbers in your bank account, which you use with a debit card or an app. Now imagine a third form. This new form is digital, just like your bank balance, but it comes directly from the country's central bank. This is the core idea behind a central bank digital currency, or CBDC. It is the official money of a country, created and backed by its most important financial institution, but in a purely digital form. It would be a direct claim on the central bank, just like physical cash is today. A CBDC is not a new type of currency. It is a new form of the currency you already use. If the United States were to issue a CBDC, it would still be the US dollar. If the European Central Bank were to issue one, it would be a digital euro. The Bank for International Settlements puts it simply. A CBDC is a digital form of central bank money that is different from balances in traditional reserve or settlement accounts. This means it's not just for big banks. It could be available for everyone to use for daily payments, just like cash. It is not a cryptocurrency like Bitcoin, which was created to operate without any central authority using blockchain. A CBDC is the exact opposite, designed to be centralized, controlled, and issued by a single authority, the central bank. The most obvious difference between a CBDC and cash is physical. Cash is tangible. You can hold a dollar bill or a euro coin, feel its texture, and hand it to someone to pay. Once you hand over cash, the payment is complete. There is no digital trail linking you to that specific purchase. A CBDC is intangible. It exists only as a digital record on a ledger. You'd access it through a digital wallet on your phone, a smart card, or another device. It is efficient for remote transactions, but every payment creates a digital footprint. Cash transactions are largely anonymous. A CBDC would be traceable to some degree. The central bank must record ownership and transfers. Strong privacy protections are possible, but perfect off-the-grid anonymity is unlikely because systems must guard against money laundering and terrorism financing. A CBDC, like cash, would be a central bank liability, the safest money. But unlike cash, it depends on technology. If networks fail, a banknote still works. When you look at your bank account balance online, you are not looking at central bank money. You are seeing commercial bank money, a liability of your private bank. Banks like Chase, HSBC, or Barclays owe you that money. It is effectively an IOU from a private company. Banks use your deposits to make loans and investments. Your money is part of a larger pool, not a bag with your name on it. We trust the system, helped by deposit insurance if a bank fails. Path 1. Person to commercial bank to loans and investments. Path 2. Person to central bank through a CBDC wallet. A retail CBDC would change the relationship. You could hold money directly with the central bank in a digital wallet. Your digital currency would be a direct central bank liability, the same status as cash, the safest form of money. A central bank can create money and meet obligations in its currency. A commercial bank cannot. If CBDC accounts are seen as super safe, people might move large sums from banks, especially in stress. That could cause a faster digital bank run. Banks could lose funding and lend less, so designs may cap balances or pay no interest to limit outflows. The most fundamental difference between a CBDC and a cryptocurrency like Bitcoin is control. A CBDC is centralized, issued, managed, and controlled by a central bank. Its value is the national currency in digital form, backed by government and monetary policy for stability. Bitcoin is decentralized, no CEO, no headquarters, no official backing, a peer-to-peer network on a public blockchain. Its value is set by supply and demand, which can be extremely volatile. A CBDC is legal tender by definition. Cryptocurrencies sit in a murkier legal space that varies by country. In the US, courts have allowed commodity regulation in some cases, while tax authorities often treat crypto as property for capital gains. CBDCs may use permissioned DLT to keep control and gain efficiency. Bitcoin, Ethereum are permissionless. Anyone can participate. The BIS says cryptocurrencies are speculative assets and unsuitable as mainstream money due to volatility and lack of an anchor. A CBDC is designed to be that anchor. In the volatile world of crypto, stablecoins emerge to peg value to an external reference. They aim to offer crypto speed and reach without wild price swings, often targeting one-to-one with a fiat currency. The result, more useful for payments and trading, bridging finance and crypto. Fiat collateralized, each coin backed by cash or safe assets in a bank account. Examples include Tether and USD coin. Crypto collateralized, backed by other crypto, usually over-collateralized. Example, DEI. Algorithmic, no collateral, code adjusts supply to hold the peg. Terra USD's 2022 collapse erased tens of billions, underscoring immense risk. Regulators warn that stability is only as good as governance. CBDCs offer the safety of a direct central bank liability no private stablecoin can match. Exploration of CBDCs is global. Over 130 countries, about 98% of the world economy, are investigating. Most are in research or development. A handful have launched. The Bahamas launched the Sand Dollar in 2020 to improve inclusion across remote islands and enable app-based payments without bank accounts. Nigeria's Inera targets payment efficiency, lower cash management costs, and formalization of the informal economy. Adoption has been challenging but notable. China's ECNY has run for years with millions of users, transit fares, online shopping, using a centralized ledger controlled by the PBOC. The ECB is in investigation for a digital euro. The U.S. Federal Reserve has issued discussion papers and sought comment, with no decision yet. They weigh privacy, financial stability, and cybersecurity. These are high-stakes decisions in a global race where each country runs at its own pace. We are at a critical juncture. Digital payments, private digital assets, cryptocurrencies, and stablecoins are rising. Governments ask, what is the role of public money now? CBDC exploration is the direct result, modernizing central bank money as an anchor of stability. Potential benefits, financial inclusion, and a spur to innovation. Payments could be faster, cheaper, and more efficient. A safe, state-backed alternative to private stablecoins, with potential for programmable payments. But risks are significant. Privacy versus anti-illicit finance is a hard balance. Digital bank runs, and the challenge of building and securing resilient national-scale platforms. Issuing a CBDC is a public policy choice with legal and monetary implications for the financial sector. As money goes fully digital, how much privacy will we trade for convenience and security? And who should we trust to manage it? Private companies or public institutions?